In this week's video, we'll review the latest charts to help us answer the question, is the stock market rally skating on extremely thin ice? In a January 5th, 2019 video with the title, Are Stocks Forming a Bottom?, we covered numerous charts that told us to be open to some type of sustainable low or the possibility of a bottoming process. We're going to update numerous charts from that video. The original look here, January 4th, 2019, based on the February 2016 major low, this A to B move into the peak in 2018 for the NYSE composite. On January 4th, we said we should keep an open mind because the market seems to be bouncing at a logical level, which was the 61.8% retracement of that A to B move. If we fast forward to the end of January, same chart, January 31st, 2019, the same story holds as long as this low holds. Similar situation in global stocks, except the losses were quite a bit more painful. January 4th, we noted that we came all the way back to the levels seen in 2014, 2015, what once acted as resistance may now act as support. If we fast forward, thus far the area of logical support has held, and we've retaken the dotted blue line here. First fib was for the NYSE composite. These are fibs for the S&P 500. Everything that we said about the chart on January 4th applies as of the month-end close on January 31st. This weekly version of the NYSE, January 4th, seemed to be trying to make a stand at a logical level. If we fast forward to the end of the month, January 31st, 2019, thus far that logical area of potential support has held. After reviewing all these charts, let's take a moment to do a little Q&A. Question: if we have seen and presented factual evidence telling us to be open to a low and or a bottoming process, and we've been covering that since January 4th of 2019, why are we still holding so much cash? Well, the short answer is we're allocated in line with the evidence. Given the strength of this bearish trend here, we really haven't seen that much improvement off of the lows. Our cash position has nothing to do with being hesitant relative to buying. Our first buy, dated December 28th, after the low was made, and then we added to that position again on January 4th. And as of the close on February 1st, 2019, we will be allocated in line with the evidence. Evidence that tells us after a V move like this, the risk-reward ratio in the stock market at this juncture is not particularly favorable. If we can clear some more hurdles and continue to move in this direction, the market's risk-reward profile will begin to improve, as it has marginally since the December low. This stock versus bond chart that we also covered on January 4th told us that despite the very, very weak market profile, we felt it wasn't prudent to load up on bonds until we saw what happened at these areas of possible support. This is January 4th. If we look at a similar chart at the end of January, and now we know that this ratio did indeed bounce in this general area, there are some additional takeaways. This is a monthly chart of the S&P 500 relative to a long-term Vanguard U.S. Treasury Fund, VUSTX. Think of TLT in the ETF world. What can we learn here? It's a long-term monthly chart of stocks versus bonds. Left side of the screen, 1999. Right side of the screen, present day, end of January 2019. The monthly indicator is Williams percent R. Measures momentum. Notice momentum here, 2000 out to the lows in 2003. Williams percent R clearly violates the negative 80 level here, moving well into quote-unquote oversold territory. This look here tells us that bearish momentum, which favors bonds and is against stocks in this case, is very, very strong here. Similar situation early in calendar year 2008. This looks very, very similar to the strong momentum look here. And you'll notice on this chart, these two periods look discernibly different from any other period all the way up to the present day. And this strong bearish momentum look here and here was telling, because after we could see that, measure it, and put it in a model, really bad things happened in the stock versus bond ratio, and bonds, especially long-term treasury bonds, absolutely annihilated the stock market during the dot-com bust bear market. Similar situation here. We can see this. After we could see it, really bad things happened in the ratio, telling us that the probability of owning defensive treasuries, that was a much better place to be here relative to the stock market as it was here. Let's compare and contrast these periods with these periods. Notice how shallow the momentum move is here. This really doesn't look anything like this. This really doesn't look anything like this. And this really doesn't look anything like this or this. And in these cases, the ratio was able to right itself, and instead of really bad things happening, really good things happened in the ratio, with stocks significantly outperforming bonds in these three cases. Thus, the million-dollar question is, does the present day look more like this, or does it look more like this, or this? The answer is relatively simple. Given what we know today, the present day looks a lot more like this constructive look here, this look here, or this look here. And thus far, this really doesn't look anything like this or this. And notice in these cases, we didn't bounce above 80. We blew right through it. We didn't bounce above 80 here. We blew right through it. And since this is January 31st, 2019, the look of this chart is in the books. Like every chart and data point that we review in these videos, this does not predict the future. It just helps us assess the probability of good things happening relative to the probability of bad things happening. And it should be noted, this look here could morph into a look like this. We get a bounce, and then we go back down for a short visit. In this case, the low wasn't in the ratio in 2010. A lower low was made before a sharp rally favoring stocks, telling us to keep an open mind about the retest or additional weakness scenario in the present day. One more important point to note here before we move on. Notice in this case, the ratio is near the 50-month moving average, then it rallies above it. Here, the weakness is near the 50-month moving average in blue, and then it rallies above it and good things happen. Similar situation here. We're near an upward sloping 50-month moving average. Momentum rights itself and the ratio does well. That's quite a bit different than this period here, where we're well below a downward sloping 50-month moving average. Look at the white space here, and there's a ton of white space here. How does the present day compare? The answer is very favorably. We've come down and stayed above an upward sloping 50-month moving average. This, as of January 31st, 2019 at month end, doesn't look anything like this concerning rollover look here in the early stages of the dot-com bear market. And this really doesn't look anything like this concerning rollover We get a flat rollover look with the 50-month, and the ratio slices through it like a knife. Thus far, we don't really have anything like that. Covered this chart in that January 5th video, chart dated January 4th. We said this ratio of U.S. Treasury bonds, GOVT, in the ETF world relative to stocks hit resistance here 3 calendar days before the major low in the S&P 500. We had a similar look here on January 4th. This looks similar to this. This look here told us A, to be open to a bottoming process in the stock market, and B, to be careful about overloading our portfolio on the conservative side with bonds. If we fast forward to the present day, that hypothesis has been helpful. This still looks like this. And there's something else we can learn. In this case, we had a long period of consolidation for the bond stock ratio. This is what looks like a bullish breakout in favor of bonds and against stocks. The bullish breakout fails, and often there's a lot of information in failed breakouts. Very similar situation here. Long-term consolidation. We get a similar breakout favoring bonds. This is very, very similar to this point here. And like this move here, this one also fails. But there is a significant difference. This one fails almost right away, literally within days. This one takes some time before we run into the failed breakout look. But this looks a lot like this here. And at that point here, the S&P 500 in the 2016 case had made an important low. January 5th video, we covered this January 4 chart saying that new highs and new lows had somewhat of that bottoming process look here in early January. If we fast forward to the end of the month and look at market breadth from a longer term and a little bit different perspective, this line here is NYSE advancing volume. So all of the volume associated with advancing issues, and then we subtract all of the volume associated with declining issues. It's a monthly chart, and this is the 50-month moving average in blue. Notice in these bullish cases where we have pullbacks that are eventually followed by significantly higher highs in the stock market, the breadth indicator contracts but holds well above the 50-month. 1987, it contracts but holds well above the 50-month. The same thing can be said for the bullish case in 1990. 1994, where after this point really good things happened in the stock market. 1998, there was a similar plunge in the stock market that was followed by significant gains after the lows were made. And we have a similar constructive white space look here that occurred numerous times during this period, 2004 to 2006, where the stock market did very, very well. A little more concerning look in 2011, but we do have white space on the pullback, and the indicator holds above a flattish 50-month moving average. Those instances are in sharp contrast to these. 2000 here, this is the dot-com bust. In 2001, unlike all of these cases here, we start to approach a flattening 50-month moving average, and we slice through it. This looks different from everything in the rearview mirror. And then a similar situation here. This look here in calendar year 2008 during the financial crisis looks significantly different than anything in the rearview mirror going back to the low in 2002, 2003 in the stock market. So the million-dollar question is, if we fast forward to the present day, This chart shows into early 2018. This is where the S&P 500 peaks in late January. Does the present day look more like this, or the constructive cases, or do we have this very, very concerning look like this or this? The answer, as of January 31st, 2016, is really self-explanatory. A picture at this point is worth 1,000 words. You can even make an argument that thus far, the end of January 2019 even looks quite a bit better than the 2015-2016 case that we cover elsewhere in this video. And it also looks better than the flash crash 2010 case, and it also looks better than the 2011 case. This looks a lot more like these cases and these cases relative to the red and orange cases. Regular viewers may also remember in the January 5th, 2019 video, we also covered this chart dated January 4th, 2019 that showed the S&P 500 weekly trying to make a stand at an upward sloping red 200-week moving average. And then we noted a similar stand was made in 2016. And you can see here in that case there was a retest several weeks later. Similar situation 2011, but a little bit uglier. We actually cut through the 200-week moving average rally. The retest made a lower low, and then eventually stocks moved higher. And somewhat similar to the breadth chart that we just covered, in 1987, the S&P 500 came back and tagged the 200-week moving average, rallied for several weeks, had a retest and tagged it again. And in 1990, we came down, went below it, moved around for a few weeks, rallied for a few weeks, and then came back and retested this low. Needless to say, it's been frustrating for stock market participants over the past 4 months or so, especially with the Fed doing a full 180 at their last meeting. However, very frustrating here in 1987, very frustrating here in 1990. Off of that frustrating low and frustrating period in 1990, which is somewhat similar to what we just went through in 2018, we made a new all-time high and then plunged. From this low here, really good things happened on the order of roughly 64% in the S&P 500. And in the 1987 case, really, really good things happened for a very long period of time. Trying to make a stand here, tried to make a similar stand in 2011. For those market participants that were able to stay in the now here, despite a devastating plunge in the rearview mirror, for those who executed properly off of this low, really good things happened for a long period of time. Very, very easy to believe that the market will continually look like this, or this when we're here. Tagged the 200-day earlier in January 2016. We rallied and came back and tagged it. Frustrating, but for those who were able to maintain and or regain their composure, and for those that executed well, it was very, very easy to put this in the rearview mirror. Now, if we fast forward a week, January 11th, 2019, in this weekly video, you might recall we looked at some of the charts from Tony Dwyer's How to Identify the Odds of a Bottom Holding Toolkit. And remember what we're looking for. This is the 1987 case, S&P 500 weekly. We'd like to see the 10-week rate of change for the S&P 500 move from below -9. It hit -30 here in November of 1987. When the rate of change slows, it basically says we've stopped plunging, trying to form some type of a low here. The odds of a low holding increase when a rate of change moves from below -9 back up to above -5 as it did here. And obviously when the 10-week rate of change crosses over the 0 line, that would increase the probability of good things happening. Cross the 0 line here, and if you know your market history after this period of consolidation, this was still an excellent long-term entry point. The VIX wasn't around in 1987, but it's the second half of that toolkit look. 1998 case, we get a plunge very, very similar to the present day. 10-week rate of change drops below -9 and moves back above -5 here. We get a low, a retest of the low in early October. And remember on the VIX, what we want to see is we want the 10-week rate of change to drop from above 80, as it was here, back to below +10. Stock market bottoms in early October. We check this box here in mid-October, and we're back to the chart of the S&P 500. Our low is in, we're moving higher. We can check all three boxes here. Box number 1, 10-week rate of change moves from below -9 back above -5 here. 2, the rate of change clears and holds above the 0 line, increasing probabilities, and this is where the VIX checked its box. The same concepts helped identify the probability of the low holding in 2011. It checked the first box here, this box. Rate of change clears 0, and then somewhat does a retest, and on the retest holds near -5. And in the 2011 case, we can check the VIX box here. So going back to the low in 2011, we can check all the boxes. Rate of change box checked here. Rate of change clears 0 here, and the VIX checks its box here. And it should be noted, after all of those probability boxes are checked, we still get a significant 1, 2, 3, 4 week pullback, telling us that we should have realistic expectations about what transpires in the next 1 to 4 weeks, even under wildly bullish longer-term outcomes. Remember earlier in the video we said that the 2015-2016 case is one of the harder cases, but our market breadth indicators look better in the present day, so maybe we can avoid something like this. But on our 10-week rate of change in that case, we check the box here on the first low. We check it again here on the retest. And the VIX does the same thing. It checks the first box here on the first low in the S&P 500 and checks the second box here. Once again telling us, even if the stock market is trying to form a longer-term bottom, we still have to have realistic expectations about what transpires over the next few months. Thus, the million-dollar question, as we covered on January 11th, in 2019, we could check the boxes that we wanted to check. Can we still check the boxes? Being, do we still have a situation where the 10-week rate of change for the S&P 500 moved from below -9, and is it still above -5? Number 2, the probabilities increase when the 10-week weekly rate of change clears 0. Do we have that? And can we check the VIX box where the 10-week rate of change drops from above 80 to below 10? Same chart, S&P 500 weekly, end of January 2019 chart dated as of the close on January 31st. Box number 1, 10-week rate of change moves from below -9 here, it was at -12.5, back above -5 when we covered it in early January. And now the rate of change has cleared 0 here. Thus, we can check this box and this box. How about the VIX? We can also check that box. The VIX, the 10-week rate of change, drops from above 80. It was at 92 in December of last year. And we're still below 10 into negative territory at -23% on January 31st, 2019. And it's also noteworthy, this mess here, all of these orange lines, were drawn several weeks ago. What once acted as support may now act as resistance. We've blown through all of the horizontal orange lines to date, and even came up and looks like we have a little bit of a retest there, and we made a higher high. Similar situation with these simple trend lines connecting this high and this high and this high and this high. Blew right through that, somewhat of a retest above it, and went on to make a higher high. All of this just speaks to probabilities. It's very, very possible, even under bullish outcomes, that we get a retrace into this area here, or even a retest of this low. Quick update on developments related to the Fed. Remember, at the December meeting, Chairman Powell said that the balance sheet policy was on automatic pilot, and he didn't see them changing that stance anytime soon. If we fast forward to the January meeting, the Fed has basically made a complete about-face 180-degree reversal on every key topic that the market was concerned about, prompting a 30-year market veteran to say it's one of the most dovish turnarounds he's seen. While that type of inconsistency and flip-flopping from the Fed, A, is really not consistent with anything the Fed has done over the past 20 to 30 years, and B, it makes it very, very difficult to make logical and prudent decisions when you're managing money. That's the bad news. The good news is we do have some clarity on their stance on some of these issues now, and at least in the shorter term, it makes it a little bit easier to make decisions going forward. For us, it's best to take the negative energy that comes from all of the frustration related to the Fed and channel it in a positive manner to reduce the probability of similar frustrations in the future, and that's exactly what we're doing with the Bird Strike project. And part of that project is to add somewhat of a second layer of defense that can assist the model in some of those lower probability situations that pop up from time to time. If you're a client, a fair question might be, why did we take such small positions in multiple ETFs this week? So let's use the S&P 500 during Friday's session as a hypothetical example. Let's assume you bought the S&P 500 here. And we know from all of the historical studies that we've covered in recent weeks that some type of retest may come even under a bullish scenario. And it wouldn't be unusual for the market to backtrack over 61.8% of this A to B move. So let's say hypothetically we felt that the bull case would still be intact if the market moved from here to here, and after that it might right itself and go on to make a higher high. From this point B to this point C, that's roughly a 9.8% decline. So in terms of position sizing, if we wanted to set our stop below this level, giving us a chance to hold this position if we do get a normal retracement, our first step from a money management perspective is to calculate this give back. The area where we set our stop determines the maximum position size for this entry. a generic rule of thumb. You don't want any entry or position to chew up more than 1% of your capital or 1% of your portfolio balance. Therefore, we know if my stop could result in a 10% loss, a 10% loss with a 10% position is a 1% hit to our principal. And if we took 10 different 10% stakes and they all lost 10%, in theory, that would be a 10% drawdown. And part of the meticulous bird strike research is to help us make these decisions and set the stop loss points or profit protection points based on model readings and the market's current profile and recent trading activity. Where you set your stop is part of your volatility to ignore versus volatility to respect game plan. So remember, a good rule of thumb is for every entry point or position, you don't want to lose any more than 1% of your principal. Therefore, if you take 5 separate positions, you wouldn't want to chew up any more than 5% of your total capital on these 5 separate entries. In terms of our 5 entries this week, rather than allowing for a 5% hit to our principal, we're only allowing for something between a 1 and 2% hit. This figure here is about 72% lower than the rule of thumb that says this could be 5%. So the answer to the question, why are these stakes so small? That's how we're managing risk and uncertainty here. During Friday's session, the S&P 500's trend strength profile was up to 10%. So in simplified terms, 90% of the questions that we're asking about the S&P 500's trend are coming back bearish or be patient, telling us that all positions have some risk of a pullback or give back should the S&P 500 pull back. So the answer to the question, why are we holding so much cash? The answer is it's the market's risk-reward profile, the facts that we have in hand. And as we noted on Twitter this week, the ETF scoring system and stack rank tells us that the market, for the most part, believes that the Fed is done raising rates or nearly done raising rates. And the strong employment report on Friday, February 1st, threw some doubt into that stance. Right now, the market is somewhat confused. The Fed appears to be somewhat confused. The Fed's confusion is causing even more confusion for market participants. And thus, we have a lot of uncertainty out there, especially when you add in the S&P 500's current profile. Think of it this way. If we were 100% certain that the stock market was going to go up, or that these 5 positions that we took this week were going to go up, I can assure you that we would not be holding as much cash as we're holding today. That high cash level speaks to a lower degree of confidence relative to the short-term sustainability of the stock market's move. Another question might be, why is your model only at 10% after a move like this? We have a long-term trend following model. We know that all downtrends have 100% normal and to be expected counter-trend moves. If you're running a long-term trend following model, you don't want to buy into every single counter-trend move. During Friday's session, from the simplest perspective, we're still in a downtrend. This is a lower high relative to this high. This is a lower high relative to this high. And this is a lower high relative to this high. Thus, until proven otherwise, via the facts that we have in hand, we'll continue to treat this as a counter-trend move within the context of a downtrend. And that absolutely positively may change very soon, but it hasn't changed yet. And the cash position that we have protects us in the event that this is a counter-trend move within the context of a downtrend. We know from our historical cases, if you jump the gun here and ignore the hard data, this counter trend move eventually gave way to the primary trend, which produced much lower lows. This is the look of our generic and for illustrative purposes only moving averages on November 15th, 2001, which is right here. So in this case, if I threw all caution to the wind and ignored the data and went to a fully invested position from here to here, it really didn't buy me that much. From here, we basically went sideways to here, and then the market fell almost 35%. Not a prediction about what's going to happen in the present day. We're just respecting the market's current profile. This is what the exact same moving averages looked like at 10:40 a.m. during Friday's session when the S&P was up 10 points. The S&P 500 is making a run at the orange 200-day moving average where my cursor is. You can see when we made a run at the orange 200-day moving average, we basically failed and dropped like a stone. In the counter trend move, oversold bounce rally that occurred in Q1 of 2008, we made a run, the 200-day moving average, in this case in red, and we failed and dropped like a stone. It's important that we continue to take a patient, prudent, measured, and data-dependent approach. This is the SPY chart that we covered a week ago. Same chart a week later during Friday's trading session. We've broken the downward sloping trend line here. We also closed above this trend line, upward sloping trend line here. And in terms of SPY, it almost went up and tagged the 200-day moving average, and intraday had somewhat of an indecisive doji look here. This is constructive, tells us to keep an open mind about better than expected outcomes in the weeks and months ahead. Very, very similar situation here. NYSE Composite, the chart we looked at last week. A confident push above this trend line here this week. Still constructive look here to daily RSI. In this case, the 200-day moving average acted as resistance during this period here, which is not the case for SPY. The 200-day moving average is not some magical binary area. This look here tells us that SPY could trade above the 200-day moving average and still remain below this potential resistance here. That's all to be determined. So far, we've been learning things, and everything that we've learned leans bullish. We'll get another read potentially if we can make it to the 200-day. The 2015 case is a good example of why we shouldn't treat the 200-day as some magical binary line in the sand. The 200-day here is in orange. If you went all in here, that didn't work out real well. If you went all in here, that didn't work out real well. If you went all in here, that didn't work out real well. Given this look here for SPY and for the S&P 500, it would not be surprising to see this type of look in the present day where the 200-day really doesn't act as strong resistance. It's all to be determined. It's also possible that we'll form some type of bottoming pattern where we consolidate above and below as we did here. Just as an update, here's the look of our generic and for illustrative purposes only moving averages relative to the bullish cases. You can pause your video player if you want to look at this in more detail. And if the S&P 500 makes a run at that 200-day, we should learn something either way relative to conviction. As these cases show, it's just not a matter of closing above the 200-day. It's how you do it that also can provide valuable information. Here's a look of our chart a week ago. If we fast forward, when the S&P was up 6 points during Friday's session, February 1st, we still haven't thrown this type of look, this type of look, or this type of look out the window. Here's the look of our box and trend line on January 25th. If we fast forward during the Friday session, February 1st, we have now cleared the trend line. Bullish info, and right now, bullish info. You can see in the 1998 case, we had a similar bullish breakout here that ultimately failed. And the sharp reversal occurred at a logical level. What once acted as support may now act as resistance. We're looking back 7 months here. In the present day, if we look back 8 months, we have somewhat of a similar look. What once acted as support, what once acted as support, what once acted as support may now act as resistance. Thus, this point in 1998, during the bottoming process, you can make an argument, still looks somewhat similar to the present day. It's also noteworthy in 1998, notice we get the reversal late in September, and then we make a lower low. This reversal occurred right at the 200-day moving average. Not a prediction about what's going to happen in the present day, just something to be aware of because we're getting awful close to that 200-day. And this look here says we really shouldn't be surprised if the S&P 500 and SPY clear the 200-day. All to be determined. And in that 1998 case, after the failed breakout above the green trend line, not only did we retest this low, but we made a lower low. And given the look of this chart, and more importantly, given this, the market's current profile, if the wrong news item comes across the wire, something like this in the present day would not be shocking given this number here. Thus far, this rally looks strong. Remember last week we covered the 100-day with the cross below the 200-day. Here's the look of the chart during Friday's session. Also noteworthy, in the 1994 case, the 200-day moving average did act as resistance, and we did get a retest of this low, and this low before the market moved higher. And remember, this study of the 21 historical cases that are similar to this look here that we covered last week, this similarity with the present day helps us keep an open mind about a retest and a drop anywhere from 11% to 15%. It's very, very possible that this morphs into something like this, or this. But the breadth thrust similarity, and this is based on hard data that we have in hand today and hard data from the past, is unequivocally and unquestionably bullish, and it tells us to keep an open mind about the V continuing. One of the exceptions was the 1962 breadth thrust case, and in that case we did retrace roughly 61.8% of the V move. Given we have data that tells us really, really good things could happen over the next 1 to 3 years, and given that we have data that tells us a move down to this area here or here would not be shocking based on the market's current profile, all of this helps us head into next week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue.